I'm glad that you guys have decided to join back with the channel for another lesson here. Let's get right into it. 2.2 is understanding price movement. Now there's many ways to understand price movement regarding technical analysis. However, there are things that these analyses are founded in, so let's go ahead and review what they are. So the Dow theory. A lot of people hear about this. This is a very important concept to understand if you ever want to trade. Many people say it's not, but I disagree. So you'll see here that the Dow theory encompasses, let's see, 1, 2, 3, 4, 5, 6. 6 different ideas, right? And I've pretty much compounded them here for you. So the market moves in 3 main movements, right? The main movement, which is its expansion, the medium swings, so the pullback, otherly known as the retracement, and the short swings. Those are daily and intraday movements. That's just tracking the movement, and those are the 3 main ones inside of a trend. So, market trends have 3 phases. There is an accumulation phase where institutions, hedge funds, insider traders are accumulating their positions, frankly, by even shorting the market to basically force other people out so that way they can accumulate their shares, hitting stop losses, things like that. So the next phase in that is the investor recognition and participation. So once they've kind of taken a lot of orders, started taking those new orders for themselves so that way they can administer that order flow, the investors start to participate because of their recognizing the patterns in the charts and fundamentally. And so they're using this fundamental and technical alignment to start taking participation in the market. And then now there is retail traders and bank traders, hedge funds. Everyone starts to kind of trade together, and it causes a big boom, right? It causes an expansion. And then there is distribution. So this is where the smart investors, hedge funds, bankers who were already inside of the accumulation phase, now they can distribute their shares to other investors who are looking to participate in the market. So now that they're exchanging hands at a higher price, the insiders and the hedge funds, anybody who is partaking in that accumulation phase, they get to now distribute at a higher price. So those 3 phases, right, happen within the main movement, the medium swings, and the short swings. The stock market discounts all news. So this is a concept that's pretty big. News, it triggers a reevaluation. That reevaluation is going to cause a stock price change. So to play it safe, investors will typically pull out before a news earnings. There'll be a big dip, and it's a good thing because all they're doing is, like it says, it's just discounting the price relative to its trend, right? It might have a medium swing downward up into the news event, and then at the news event, right, it continues to discount until it has a reevaluation of its pricing, and then you might see a sharp turn in that market if it's considered devalued. And then they'll accumulate more shares after they made their determination, and then they can begin the entire phase again for a trend. So, stock market averages must confirm each other. So this has to go in line with seasonal tendencies, maybe checking that everything every 3 quarters, semi-annually, so every 6 months, every 3 quarters, or excuse me, every 4 quarters, right? So every 3 months, or semi-annually every 6 months. Very important. You will see that there are seasonal tendencies that take place in stocks, specifically good ones like Walmart, retail, consumer based, the seasonal tendencies on those stocks usually do really well. You use these averages though between the markets, and you can use smart money divergences as well, where there are markets that correlate with each other, right? So that's the asset correlation, and they're using this correlation to depict um, if both markets are moving together or if they're moving inversely. So if you see a market reversal to the upside, right, for one, and you see a market reversal to the upside for another, and they're in a positive correlation, right, that is part of your it's a smart money tool. It's part of using something like smart money divergence, which is very, very common in the trading world. um, you're using these correlations to even track your seasonal tendencies as well. So you'll see the seasonal tendencies in that asset correlation. You'll see how specific stocks and specific industries will trend together. There will be a correlation in their price. And then, of course, the biggest one is, now I took a nice big pause here because this is the biggest one. This is the elephant in the room. Tracking indices and ETF trends. Now, if you're tracking and you're trading in the Forex market, the indices and the ETF trends, um, that's really amazing. That's good, because if you want to trade the Dow Jones, if you want to trade, um, the S&P 500, the Nasdaq, you're gonna need to track these indices and ETF trends, and you can trade a lot of ETFs in the stock market. And most of the time, you're just going to be following what the major indices do, and you should find pretty big success with that. So stock market averages must confirm each other. The biggest one here is that you have to track those indices and ETF trends to really gauge the strength of the market. And if the top biggest stocks are retreating, uh, obviously it would be smart to think that even smaller stocks that aren't a part of these big major players would also retreat in price. And opposite doesn't really occur, where if it's a bull market, it's guaranteed that the stock you're getting into is a bull market. That's not necessarily the case. If the indices are in a bull market though, and ETFs are having a bullish trend, you should be trying to trade and track the stocks that these funds have allocated, and try to trade those stocks that are inside of these funds. For example, like Apple or Amazon or Walmart, right? Things that are inside of these ETFs and indices that have major liquidity. There's a lot of money moving around in it. And if you want to catch favorable moves, you want to make sure that there's the money available to do that. So that comes down to this, talking about money. Trends are confirmed by volume, right? So there's this order flow taking place, right? And this order flow starts taking place in the accumulation phase, right? And then they establish an expectational order flow, right? And that's exactly when the investor's recognition and participation starts taking place. Well, in the distribution phase, that's when they start really targeting supply and demand. They target both of them, um, and they're doing that to accumulate more orders in a sense, um, but they're distributing at the same time to all the unknowing investors who probably will end up getting stopped out and um, can't handle the drawdown on their equity and account. So, but supply and demand moves it all. But in this distribution phase, you'll see that there is a lot of supply and demand movement. Um, it's because it's come into this distribution phase where it's entering a lot of short swing movements, and they're doing that to rack up orders while also distributing those orders and getting them off their hands. So basically, tricking both people on both sides, um, like moving in channels, moving sideways in consolidation periods, They're basically just trying to induce people to absorb their order flow, absorb their orders. So very important to understand, um, especially that trends exist until definitive signals prove, okay? Definitive signals prove, right, that they have ended. So there's a lot to a market reversal phases. That just depends on the perspective you're looking at, whether it's a macro phase, if it's, just, a daily, it's like just like that, just weekly to daily to even, all the way to, I'm going to say all the way to the 5 minute chart. Like you can trade all these charts, you can trade every chart, and there's going to be trades within those charts and setups within those charts. But you have to maintain a perspective of being with the current trend. And that's a huge, huge thing. You don't want to predict the reversal, right? You'd rather just follow the current trend, right? You want to follow the current trend. And so that's determining whether a reversal is the start of a new trend or a temporary movement, and the current trend is not easy. Um, there's going to be a lot of times where you'll be applying the knowledge and you'll see it not work because it doesn't work and it's all lies and it's all fake, but it's not true. Um, it's just that you have to learn how to utilize the knowledge correctly and then create checklists and having a system to make sure that you follow the logic continuously. So, it all comes down to pullbacks and expansions. There'll be pullbacks and there'll be expansions. Market will consolidate, move around. You can call it whatever you want, retrace, but then it'll expand. So understanding that the Dow theory is three main movements in three phases, right? And basically working price, right? That it's moving with other assets and having correlation where the money is generally flowing. We have to watch the market structure and the order flow taking place, and that is what a trend is. A trend is an order flow, and that's how we build that expectational order flow where we can develop a bias whether to buy or sell, and follow that trend. So trends exist until definitive signals prove that they have ended. This is big. Don't try to predict. You can anticipate but never predict, and always have many confirmations for a trend reversal. Now, determining whether you guys really took a lot away from that or not, I'm not sure. But as I always say, pursue core market knowledge. If you didn't understand something in this that you still have answers, you still need answers, you still have questions, go ahead. Just get on Google. I encourage you. Start looking for more. You will find it. So this kind of leads me into the Elliott wave theory. Now, the Elliott wave theory is very cool. He's basically taking the Dow theory and he's trying to create measurement to it, right? Considering these different phases. So, right here, we can just start off by looking at this, and there are these tools here on TradingView. As you can see, that this is common knowledge here for, I believe, for traders. So you can see here for 1, 2, 3, 4, right? 5. And then we see, right? We have a little, whoops, there we go. We have a little correction, right? Or you can even say this. And usually within these waves, right, you can see subwaves as well. So you can see here that the Elliott theory, right, we have a consolidation period, a retracement at the top here of the fifth wave. And all we're going to have to do is measure this and be patient. So A, B, C, right? A, B, C, right? And then that same consideration here. A, B, C. So you can see here that within this corrective wave, there were corrective waves. So that is pretty much what the Elliott theory is. It is tracking the expansions, the trend. So let's say here we go again. All right. So this one's a little bit longer, right? So this one's still an Elliott wave, right? See W, X, Y, X, Z, right? So it's basically just a double zigzag, what people call it. And if you just take a look inside of the double zigzag, typically it could be almost any sort of corrective pattern. If we just take a look here, we go from here. So A, B, C, right? And then you can see the market moved up strongly, but then that market started to go back down there. It got a little choppy. So those are the corrective movements of the Elliott wave. And as you can see, after that was finished, we continue to go on and track it Elliott wave style here. And there's lots of patterns to take place within these Elliott waves too. Just for example, like this. So this is a bullish harmonic. So you can say that after you tracking this trend, you see the corrective phase, right? So let's take a step back here. Let's take a step back here. Look at this. The main movement is the expansion, right? And that comes from the accumulation. Here's our accumulation, right? This is people accumulating orders, creating a market reversal. And they're making that reversal inside of discount pricing underneath these lows here. So they're accumulating these orders at a discount. Okay? They have built up a lot of orders to take here, so they've stolen those orders from any stop losses resting underneath here. And now you can see they start their accumulation phase. So they start to accumulate. You get our 1, 2, 3, 4, 5, and we continue to expand, right? Another corrective sequencing here. And by this time, you have to know that this market is bullish. So you can see here that market again comes up above these highs, right? And we'll get more into how this is a good confirmation of how when a market breaks a high, what that means, creating new structure. And you can see though that they have an XABCD harmonic pattern, commonly known as the bat pattern. And there's different kind of patterns with the harmonic where people get real specific on the measurements, but you don't have to overcomplicate it really. However, you can use the Elliott theory to create measured movements, and that's kind of what goes into premium and discount pricing as well as Fibonacci trading. So if we just take a look here, now we see this market came up, right? It had its retracement, right? It had its distribution phase. Then we see this market come up, right? And it breaks structure, right? So it's a break of structure here to the upside, right? So they're breaking market structure to the downside. So if you take an interesting look here, this pullback, right, was this harmonic pattern, again, can be measured. but it's displacing price to a specific area, right? So if we take a look here from this point all the way to the high, right? This is our premium pricing here in the red, and this is the discount pricing relative from this low to that high, right? So this is where you can see right along here, here's accumulation. This is where the smart people are accumulating, right? You can see that boom, here's the move made, and an A, B, C corrective pattern. So this is where the investors and smart investors, this is where their pattern recognition comes in. This is where they begin to recognize, hey, I should join this market going up, right? A, B, C. And then you can tell that they made another move upward, right? Just as people had anticipated, A, B, C, right? They moved up. Then you can see that the smart people, right? The people who want to distribute their shares. So the people who were got in here now are distributing up here in premium pricing. And as they made their way into discount pricing, again, they have the pattern recognition. People see that the structure was broken. They see this market wants to turn around. They see the bullish harmonic, so it's in a corrective phase again. And they also did not violate this low. So, what does that mean? That means we have the beginning of an expansion. So, if we go ahead and we mark this, 0, 1. Oh, here, let's make this a little bit simpler here. 0, 1, 2, 3, 4. Let's just say this is 5 here, right? We can see that once we enter that discount pricing again, that the market moved higher. Well, this is an important concept inside of the Elliott wave, is that as we can see in the first impulse moves, that number 2 here, right, from 1, 2, this one right here is important because this low should never be broken, okay? It might be violated, and some people would disagree with me saying it should never be violated, but if you do some back testing, you'll see that sometimes it could be violated, but as long as it is not broken by a candle body, you'll see that it might even form a double bottom pattern right here, which it almost did in this example as well. But this low right here, that should not be violated. That should not be taken out. So you can see 1, 2, 3, 4, and then a strong 5 wave, right? Now you can see that they just had this nice push down, and we could just see that as categorize that as just a short swing. It's just a short swing. It's just a daily swing down. That's what that is. Just a quick short swing. And you can begin to develop a theory, though, overall, that you have your main phases taking place, that you have your accumulation, right? That you have your expansion, and then you have your redistribution, or excuse me, distribution, and then the market moves up. And this is redistribution here. And then they start moving the market back down, and you can see that the market basically trails, right, all the way back down to where it initially begun its move. So, very cool concept. If I was trading the price action here, the price action that you should have been watching was number 1 here, the first new high. That is the price action there. And you can see that the first dip into that, they had a very strong impulsive move up. They came down, swept those orders, again accumulated, and then started their phases all over again. And so those can all be accounted for inside of the Dow theory, the Elliott wave theory, discount and premium pricing, putting them together and getting very specific with Fibonacci trading, where you can be anticipating very specific things here. So let's go ahead and take a look. So if we just go ahead and took this low here to this high, right? We have Fibonacci here. So I need to save this one. Okay. Now I'm going to have to reset this one to default here. Cannot seem to find where I would reset this to default, but that's okay. Um, I guess I can just turn on the ones I have on this. So okay. So you can see it might get a little confusing here. Just bear with me, okay? Um, you can see though that from this low to this high, right? Again, here's our 50% level. So here's our marker of premium and discount pricing. And you can see clearly that after the market made its strong move upwards, that it retraced down into discount pricing, and using the most common retracement area of the 618, 0.618, you can see that the market reacted strongly to this demand area, and that is a good thing. So you can take this concept and go ahead and move it right here. You can see right here from this low to that high, they made a deep retracement into demand pricing, right? They went all the way into the 707. Let me go ahead and see if, because there's more than this. So there is, I guess it's not on here. That's okay. So like there's like the 78.6 retracement level. That's also real common there. So you can see though that it made a retracement and it was a measurable move, and that we could also have used market structure and pricing to categorize this move as a pullback, right? So my favorite part here is, let me show you. If we just wanted to outline what you know already, we understand that investors have already pulled back here, right? And that they've already grabbed more shares and made a move higher. So here's our price action, right? Oh, actually, I have a template for this here. Look at that. So there's support here. Now, on top of that, right, since we know this is where the accumulation was taking place, right, they're distributing, right? So it was trading hands, and you can see that when they came back down to this area, they wanted to grab more shares. So they were manipulating these lows here, but we can get more into that because I just want to outline this fact here. So you can see that underneath this low, it was swept, right? And you can see that this demand candle, it's an institutional sponsorship candle, right? You can see that this demand candle was played off of, right, in line with, right, the 50% level of the previous set, right? And on top of all of that, there was price action support. So there was institutional sponsorship demand, right? The mean threshold of the trend, price action support, right? And once we came out of this area, we had a strong bullish engulfing signal, right? And then even if you missed it there, there was a second one right here. So then you could have been looking to buy this up after your, right, recognition, after your participation. So there's very cool moves like this that you can begin to find just by putting and connecting the dots together. So you can see here, right? broke structure upward, came down to a nice retracement, deep retracement into demand. And from that area, you can see how strong this market reversal took place. It was a very strong reversal, and that is what the Dow theory wants you to catch. It wants you to catch, right, the best movement of all, which is the expansion. You want to catch the expansion. You want to watch for accumulation phases. You want to watch for distribution phases and continue your investor recognition and continue to participate in your favor. Um, Always keep track of the news. Be reevaluating yourself. Make sure that any decisions you make are in alignment with the market itself, right? You don't want to be a lone wolf. Move with the market as a whole. Move with it. And the reason why you want to do that is because the market as a whole has order flow. It is creating structure with its order flow, and that is giving everybody expectational order flow, expecting a trend, following the trend, thus making demand over supply more powerful or supply over demand more powerful. And these trends will exist until there are definitive signals that prove that they have ended. Okay? So, putting all that together, you will start to see how to view the market with a specific perception that is calculated. Just as we outlined with the uh, Elliott waves here, and the patterns it creates here. So um, like this one's real common. So another bat pattern, shark pattern, whatever people want to call it. It's just the same thing. It's just a market correction. You can see the market came up, came beneath that again, right? They took all of the orders, right? They accumulated again, right? And then after they took the orders from unsuspecting investors, and then they moved. So you'll see this over and over again, how the market itself, right, is going to create short swings, right? So that way it can create a main movement and actually expand by accumulating, right, unknowing investors and poor people who are not aware of what's going on in the market. Basically, they're taking place to short the market and to accumulate orders in their favor. Then they start administering those orders, and that begins the investor recognition and participation. And yep, then they move to distribute. Um, and you can see that these market phases will take place in both directions all the time, and it's always going to be supply versus demand. It's always going to be order flow, expectational order flow, and supply and demand. It's all about money. It's all about the amount of orders in the market and how much money they represent. And with that lesson, I'm going to wrap it up. It was a lot to digest, I'm sure. We're going to be getting into this a lot more as we continue to move forward. So if you need to watch my video again, I understand. Make sure you guys are taking notes and studying. Please pursue core market knowledge. All right. If you guys found value in my video, please hit that thumbs up button. If you're new and you don't know anything about what's happening right here and what's going on, please start from the beginning. You'll see how I move you along and develop a sense of understanding for you over a time period. So make sure you are pursuing that core market knowledge, everyone. As always, peace, love, and harmony. Thank you for watching, and I wish you the best.